Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at Garmin Ltd, ticker GRMN. I was asked about it the other day. They were sitting on rather large returns and asking if they should hold or what they should do. It looks really good fundamentally, but does also look significantly overvalued. So I wouldn't completely sell out, but taking some of those gains off the table, especially if you see a better opportunity, would not be bad because the returns here are okay, but they're not the best. So getting straight into it, coming up with a fair value of $150 or so, discounted cash flows of 133.5, and it's currently trading for 205. It's been as high as 246 and as low as 158.9. Earnings yield 6.98. So for what we're paying, we'd want at least $10.25 per share in EPS. And what we are actually getting is this last year $7.35. This year it's expected to be $7.95, and next year $8.60. So low, not what we would expect for what we're paying. Cash flows super strong, 19.67, above their average of 16.9. Really solid numbers there. Dividend yield 1.45, lower than their average of 2.14, which could also signify that they're overvalued at the moment. Payout ratio of almost 40% this last year off this year's expected EPS, about 37. So they do have room to grow it. That's a pretty healthy dividend. They're slowing down quite a bit on the growth of that, though. And we can take a quick look at the chart and see big jump from 21 to 22, and it has slowed down significantly since then. Then we have returns, ROE almost 18%, and that's not even diluted. They have a very good balance sheet here. ROI 14% and ROA 14.6%. Gross margins 58.7, on average about 58. Net 22.4, on average 22.2. So fundamentally, super solid business. It's just the actual valuation, which you tend to get for these incredible companies. So then we're coming up with a PE ratio at the moment of 25.8, growth rate of 8%. So your PG is 3.16, and we like to be that as close to 1 as possible. So again, signs that it is overvalued. I would love to hold a company like this, but not at the price that you're paying for it at the moment. Revenue growth seems to be pretty consistent, around 8 to 9%, 8.1 over the last 3 years, 9 over the last 2. Analysts are projecting 8.9, and then about 8.3 over the next 2 years. So I think 8.5 is pretty fair for the thesis. Might be able to bring that down a little bit if it does taper off over time. Share count, they bought back some shares 3 years ago and issued more over the last 2. So ideally, they're buying back shares. This being flat would not be bad. I mean, once they start buying back is where you really see the returns for shareholders. Cash flow, if revenue is growing at 8.5, cash flow is growing at 6%, brings them to a cash flow yield of 17.5. Not as high as it was this year, but still above their average. So there might be a little bit of wiggle room with that number. Assets consistently 7 to 7.5. So we'll go with 7 there. Liabilities 0.8 over the last 3, 5 over the last 2. So they recently issued a lot of debt. I would like to see this come down. In fact, we'll take this down to a 3, which helps things out a little bit. Dividend, they've definitely slowed down on that, and the margins are super strong as is. I don't know how much more room they have to grow those. Maybe a tad bit there that we can play with. So with that thesis, you'd be looking at annual growth in the fair value of about 5.9%, which is not the 8 to 10 that we like to see from markets. Once you factor in the dividend, you're talking 7.36. So still, I feel like returns are pretty low for this company. Now, you probably have some nice stability and predictability with these fundamentals, but return-wise, not the greatest. Over the last 2 years, I can definitely see why returns were good. That's why I would hold or trim. I wouldn't sell or buy on this one. And we can take a quick look about how everything is trending. Back in 2020, you see that the dividend was one of the lowest valuation metrics, and it's come up and is one of the highest as of late. But then we have the cash flows, which has followed a similar trend, bottom two to top two, and then the fair value of the stock, which is sandwiched in between everything. Right here, the share price this last year was very low compared to everything. Last year would have been a great time to buy, and the stock is up $100 since then. It's doubled. And if you sold out at the peak, $250 or so, then you got 150% returns. That's the kind of thing that we look for. Anyone who bought in 23, 24, it was a value play, and they cashed in on it. It overshot its valuation, so with those kind of returns, I might actually just take the money and run, honestly, instead of allowing it to get back down to its fair value levels and losing like 30%. But everything is so tightly clustered together for this year and next year. It just shows like how solid this company is. But I wouldn't be surprised if there's a bit of a pullback in the price. Especially, it is down $50 from its peak. It is down almost $50 from its peak. So on this one, super solid fundamentals. Could have been a value play if you got it in 2023, 2024. At this point, the market's run with it, brought it up to a high that I don't think it's worth paying, especially for the returns that you're getting. And I'd hold. If I could get into this thing for 150, if it goes back down to around its 52-week low, I might consider it just for how solid it is and such, and really grow their market share. And that's really what you'd be looking for, because you need more growth over what they're currently putting out. So I want to thank you guys for watching. Please like and enjoy this video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.